Dollar again fell as both Fed Chair Jerome Powell and also Bank of Japan Governor Kazuo Ueda made remarks at the Jackson Hole Symposium that affected the currency pair. Powell's opening the door to a rate cut in September by emphasizing labor market weakness um, weighed on the dollar. And Ueda also said that the relative strength of the job market in Japan, driven by immigrant labor, uh, could keep up wage price pressures. So the increased expectation of a rate hike from the Bank of Japan helped support the yen as well. Ueda stuck to his hawkish tone when he said that wages in Japan were expected to keep accelerating due to a tightening job market. He noted that wage increases in large companies were spreading to smaller firms, which would likely contribute to upward pressure on inflation. Before the Jackson Hole Symposium, markets were expecting a rate cut by the end of the year, but after Ueda's comments, the chances of a rate cut in October rose to around 50-50, according to the futures market price. And similar story with the Fed. Markets were expecting a less um, likelihood of a rate cut in September, but the chances of a rate cut have now increased also on in the US. And we are here looking at the potential for further continuation to the downside of USDJPY. Now, there is a few things that we need to speak about here. Okay, first of all, we have come up to around the 149 level, right, which is where we stopped at the median channel that moves to the upside here, and prices have started falling from there. We are and we have seen a large drop to the downside, not as large as at the beginning of August, but quite large indeed. This brings into the gameplay here a potential retracement, right, that we saw up to 50% over here, right, which means fractally speaking, since we saw an initial drop, sharp drop and correction to the 50, that could reoccur. This brings up um, the 147.70 as a potential resistance level, right, with the potential extension to the downside, opening the door to, uh, well, I will tell you now, and this is the second interesting thing that we are currently seeing on the top in the charts, and not just to this more than that, an open triangle pattern that would, well, typically we could measure from here to here, right? Because this is kind of the measured move, and place that on the breakout level, whatever that would be. Let's say, just make this assumption for now. That would bring us close to 143.50, which of course opens the door to the previous low at 142.67. But for now, obviously, before we even get there, we need to break 146.18, 145.85, and then eventually come and meet support at the lower channel. Now, how likely this is to play also depends on whether we do break below the 145.87. Why? Well, because if we don't and we do move down there and then we start moving higher, what we could essentially see playing out here, yeah, is a potential consolidation until we kind of see a breakout for a head and shoulders uh, move to the downside that would eventually drive us higher. The chances, though, of a head and shoulders, if we look at it from a corrective perspective, right, um, are not, I wouldn't say that they are too high. Why? Well, because typically the neckline forms around the 38.2 to the 50%, right? We have a shallow pullback for the formation of the neckline. In this case, we do see a deep move uh, down to the 61.8, which kind of brings a question here on whether this could play out as a head and shoulders. This is, to me, because the depth is larger, this adds on to the possibility of a potential decline, which is what we are looking at here. So given this structure, okay, although I repeat, a head and shoulders could still play out, but we're not going to know until we break below that low over here. Also, another thing that we're looking at is that, this is a bit of an extended right shoulder versus a left, if that's the potential that we're looking at. So we'll be looking, there is two ways to play this, obviously, but if we would be looking for a breakout below the previous low, we would be, we could place our stop just above the 61 point at 78.6, let's say. Oh, excuse me, I've got the wrong one here. Oh no, just above 76, 76.8. If the Fibonacci extension gives us, of course, from bottom, this is a triangle pattern, so we'll be looking at this to get down to the extension of 144.45. This to me looks like that would be the first, of course, target. A bit of a conservative entry with a okay-ish risk reward ratio. Okay, given of course where we currently are, okay, an entry could be even at the 50%, which would be right at the top, but this is considered more of a aggressive entry, to be fair. But given the fact that we're looking at a potential mini size dead cat bounce, okay, currently, the chances of a breakout, the chances of forming, if we do form resistance, then the chances of further continuation would increase. Another way to measure, of course, potential targets would be to look at the actual correction from the top to the bottom, and currently at 147.50 with the 100 and 161.8 Fibonacci's, both considered as potential levels to take into account. Now, if we do break, guys, above the 70, the 61, I would say is 61 is not, it's rare for a dead cat bounce, but if we did break above 61, 61.8 over here at 148, that would increase the chances of, well, us coming up to around 149 as we were before, and a potential extension of this pattern, elongation. I'm more like a correct word here, since we'll be looking for something like this. Now that will be a wave A and B and a C and a D and a E. Supposedly is the fifth wave is done, but whether it continues or not, it's not known, because the truth is that this could be, for example, the A and the B, and that could be C, D, and E, and externally we could have another triangle, if that makes sense, like A, B, C, D, and something like E over here, which would mean that we have one more wave to go.